Okay, but so Ndogs and Wogs, there are pretty much two types of them. Well, there's actually three types of different ones. You have your um electronic trading hours and dog. You have your electronic trading hours and wog, and then you have your regular trading hours and dog. This is going to be also known as your opening range gap or org. Okay, and this one you'll have three of them on your charts, while for these you'll have five each. And we'll kind of go over what these are. But in short, um, your end dogs and end wogs are your form of true fair value. It's can be called as like a black hole for price. If you see a lot of them clustered up together, chances are price is going to go towards that direction. Um, yeah, and they have a lot of value to it in terms of how the algorithm refers to it, and they're a really good point to use as like a fair value gap, to use it as a mount, or the main reason how I use it is as a draw on liquidity. If you see it like in a premium, or if you see it in a discount, for example, like let's say you're up here, you're doing a trade like something like here, and you get in somewhere here in this fair value gap, right? And generally, when you're doing trades like that, you want to target liquidity or some form of liquidity uh in discount here. If you're selling in a premium, you want to target something in discount. And if we have a NWOG, like something like right here, and I don't think price is going to come down to this low here, right? You can just come in and target this low right here, and that's a really good draw on liquidity if you're not expecting price to come through and come here. And this will also be usually a place of where price consolidates before choosing the direction to break down lower or to go higher. And once again, it's a form of true fair value. So we'll go over what it looks like in the charts. So first thing I'll go over is the regular trading hours and dog, or also known as your org opening range gap. So by changing, coming down here on the bottom right here, you can change between regular trading hours and electronic trading hours. And what your regular trading hours is just your New York open time. It goes from it goes from 9:30 a.m. Eastern time all the way up to 4:15 p.m. Eastern time. And the price difference from your 414 settlement price here and your opening price here. This is going to be your, hold on, right here. This is going to be your opening range gap or your regular trading hours and dog. Now this will act the same way as any other and dog or NWOG is going to tell you. It's going to tell price to gravitate towards one of those things, and something that you have a 70% chance, 70% strike rate of happening is that from 9:30 open, from 9:30, the times in between 9:30, see if I can get this here, 9:30 here to 10 o'clock. This is known as your opening range, like your opening range price, this 30-minute window. Chances are from here, this price leg will gravitate towards the 50% level or the consequent encroachment of this gap, or hit that gap, and that's a 70% chance of happening. And you'll see this exact same thing happen in Asia when we go over our electronic trading hours for um for that end dog. So do we have any questions about this opening range gap real quick? Once again, you have three of these. Okay, awesome. I'm going to come here. I'm going to use this indicator real quick just to kind of show you guys the quarters of it and everything about it real quick. So we'll kind of get that here. Turn it on, and this is exactly what it looks like here. It's going to look, yep, okay, that's all good. Yep. It's going to look like this. You're going to have your consequent encroachment right here from your settlement prices here. Price comes down, trades the 50% of it today, right? And once again, this acts as another new day opening gap here, right? I don't know why this one has five of them. We should have three of them. This one should. Oh wait, shit. Hold on. Wait, no. Put in the wrong one. Hold on. Oopsies. My fault, guys. Anyways, it should be your regular trading hours one here. Guess this one's bugged out. It doesn't show, but let me see if I go into electronic trading hours if it's going to show. Oh, there you go. It shows here. Why is this one bugging? Okay. This one is bugging. We don't trust this one. We're not trusting this one. Let me see if it's this one. Hold on. I don't really use this indicator that much, so. Okay, no. These are just both bugging. Don't trust this fucking indicator. Anyways, um, yeah, that's your opening range gap. And you have one every single day, no matter the size here. So this was from Wednesday to Thursday, and then we can look at our um Thursday to Friday here, which is gonna be yeah, let me see here. Right, here it is here. It's very small here, but you do have it here from this low up to this high. Remember, it's from the opening price of 930. So even though in the first minute of 930 we came down here, this is still your opening range gap here. So if we want to draw our quarters and our consequent encroachment from this, we can kind of get an idea of what price will do from here, right? So in the first 30 minutes, you're going to see price come down here, and you can see price kind of respect the lower part of it right here to the bodies, comes back up, comes back down, does a couple more stabs at it here, comes here, does a couple more stabs at it here, right? Like I said, remember what I said, how we're going to consolidate around here, right? And then we come back up, respecting this upper quad level here. We're finally starting to break down, and once we leave it, right? And now we can use up to 3 of these. So come here and show you guys what 3 of them looks like on the chart here. Something like this. I guess I'll just use the fib from now on, but go from up here, the opening price of 930, the settlement price at 414, right? And we can see right here we have the consequent encroachment level of the last one right there. Look where price is rejecting off of right there as well, right? You have another quartile level right here. This is the bottom 25% of it here, right? You can kind of see the bodies respecting that and price kind of working in this quartile here. You see how we work in the quartile? We break down. We see how we have a nice breakdown here. You see once we reach the low of it here, we have another consolidation, right? Until we kind of break up through it and we kind of find a direction. So, do we have any questions about that? Once again, you put 3 of these on your chart. You guys can probably find a good indicator for it. Actually, I do have one here. It's this one. This one's a pretty decent indicator for it here. Let me just show these like this, right? This shows just one. I think you could probably make it do 3. No, you can't. Okay. Well, this one shows you just one, so you can find which one is in the current day. Yeah. So the basic model is that you're going to take one of the first fair value gaps that form within this time of 930 here. So let me just come here. So there's a 70% chance of consequent encroachment of the opening range gap getting hit in the given day. Now the chances do go down a little bit. In the first 30 minutes, but generally it's going to be hit in the first 30 minutes. And if it's not, generally it's going to be hit later. But there are times where you just run from it, but generally it's going to be within the first hour. And in the first hour is when you're going to see that 70% strike rate. So from 9:30 to 10:30 is when you're going to see that strike rate. So we'll go here and I'll kind of just mark those out real quick. So from 9:30 right here, all the way to 10:30 right here. So this is your hour, and this is your 70% strike rate chance here, right? And what you're gonna do is you're gonna take a fair value, one of the first fair value gaps formed, right? Which in this case was here, and you're gonna take that down right to the consequent encroachment of this right here. And this is actually the trade that I took on this day. I didn't quite take it here. I took it off of this inverse gap right here. This inverse gap right here. I took it around right here, stops above here, and you just target mid gap. And this is going to be your 70% strike rate, just like that. And we'll look for a couple other days. It's usually better when it's a little bit bigger, but let me see if I can see this here. So coming back here again, right? You have your new new day opening gap right here, or your org opening range gap, right? One of the first fair value gaps that form here. Boom, price comes down back to the consequent encroachment of this level here, right? Consequent encroachment of this opening range gap. Yeah, I did hit it beforehand, but you can see price gravitated towards it. You could have taken this first fair value gap and took it back down there again. We'll go and we'll find another day like here. Now here is where you kind of get that issue, right? You have such a big one here that even if you did take your first fair value gap that formed, bearish fair value gap that formed down, you do get a good run, but you do not end up getting that hit, that 50% level hit. But if we play out price a little bit longer here, probably go into the 5-minute chart, see if I can get this down here. Price eventually comes back down to the consequent encroachment level of this here. Maybe it wasn't in the same day, but it eventually comes down and gets that, if that makes sense. Does that answer your question there, Dom? Perfect. Okay. So the next form of opening range gaps that we're going to use here is we're going to use the electronic trading hours. So once again, coming down to the bottom right here, going to electronic trading hours, we're going to go over the Ndog. Now you're going to have 5 of these on your chart, and this is very similar to the other opening range gap here. You're going to look for your close price. So futures market are open 23 hours a week. It closes between 5 o'clock p.m. Eastern time and reopens at 6 o'clock Eastern, 6 p.m. Eastern again. So, and the gap in price, that is what's going to be known as your new day opening gap. So we'll look at it right here. Let's see where it is. Okay, this is actually a pretty good example. When you see no gap in price here between 4:49 and 6 o'clock, your new day opening gap will just be the price level, because since they're equal, will just be this one price level here, and this will be your new day opening gap here. And you can see us respect that there. And you keep this on for 5 days and it'll act as a draw on liquidity. You see how we consolidate around here. Let me see if I can find an actual new day opening gap. Actually, I just used the indicator for this shit. Just tell me find it. Okay. Let's put these on now. Okay, here we go. Yep, this is another good example here. So when you see an overlap of between the close and the open here, this is going to be your new day opening gap here as well. So you draw this from this high to this low with the consequent encroachment level here, right? And this is going to be form of true fair value. It's going to be acting as a draw on, not only a draw on liquidity, but it's going to be acting as a fair value gap and stuff like that here as well. So you can see here, price comes up here, rejects, finally breaks through it, comes back up, touches consequent encroachment and falls. And now this is pretty much another way you can think of this. So from the times of, just like how we had that 9:30 to 10:30 window in New York to find price to come into consequent encroachment of that. In this case, you're going to be looking at the times of 7 to 9 p.m. Eastern time, right? And you want to find a fair value gap that trades to this new day opening gap if we have not touched it yet. Now we could have touched it like here, came down, swept this liquidity, came back up, and if we had relative equal highs here, you can expect that to be touched and ran towards and this time as well, in between the 7 to 9 o'clock p.m. Eastern time in Asia. And you can see that these are levels of reference that you can keep out. This was the Thursday one. We can see how price came into it here on Thursday, kind of came up, use it as a draw on liquidity here, consolidate around it, and then finally, once we're gonna break away from it, and we can see the same thing here, right? This is just that one line, right? You can see rejected off it to the tick, wicked around it, right? Where are we? Where are we consolidating again? Consolidating right on that new day opening gap level, right? And then we finally break away from it, and when we break away from it, we break away from it, just like that, right? Come back up, consolidate around here, consolidate right here a little bit, and then we break from it. Continue, come back down here, consolidate, and then we break away from it. consolidate, break away from it. So basically what's going to happen is that around these areas, you're going to see price consolidate around in here, work these levels, and then you're going to see price break away from it towards one direction. And when it breaks away from it, it's going to break away from it really fast. So just note to have these levels on your chart and just be wary of those consolidation levels. But once again, these are really great draws on liquidity. Let's say if you took a short somewhere here, you could have targeted this level right here. What would be your next target? This new day opening gap level, once again used for a draw as a draw on liquidity here. And you can see us come back down here, take out the liquidity here. And what do we do right by this? We consolidate one more time, consolidate, consolidate, consolidate. Once again, you have 5 of these on your chart. Do we have any questions about the new day opening gaps? They're drawn liquidity in a form of true fair value, acting as not only a fair value gap, but a very important place in the market that the algorithm will refer to time and time again. Now you can, if you really wanted to, you can have more than 5 of these on your chart, but they get less effective if you after the 5th day. So you'll have Tuesday, Wednesday, Thursday, Friday, and then Tuesday again. Reason why we don't have a Monday on there is because your Monday would be your new week opening gap. Does that make sense? Awesome. So we're now going to move on to our new week opening gap. So you're going to have 5 of these as well. This indicator messes up, so you can't be on the 1 minute time frame here. But this is going to be from it's going to be on Sunday, and it's going to be from close price at Friday at 4:49 to the open again at 6 p.m. on Sunday Eastern time. And that is going to be your new week opening gap, or basically your Monday new day opening gap. You're going to have 5 of these here. So it's going to go back a span of 5 weeks. And once again, just like the new day opening gap, they're once again going to act as a draw on liquidity and true fair value, and something that the algorithm is going to refer to very often. And when you see something like this where they're intertwined, or when there's multiple in one here, and I'll also add the other Ndogs here, they're going to be in red, so you can also see that happening. But you can see here how we respect that 50% level right there, and we run away from it. And same thing here, it's going to be between the times of 7 to 9 o'clock. You're going to see price kind of come back down into this Nwog here, and this Nwog, once again, you extend it out for 5 times all the way up until its time has expired. And you can see just how powerful it is. Price comes up, price comes down. Look at that 50% level, very active here. You can see price comes here, bounces off of here if you were targeting here. Now another reason why we bounced here, right? You have your new week opening gap here, new week opening gap, consequent encroachment level here, consolidate here. They come into the consolidation here, right? You have another new week opening gap here, and look how precise it is. 1 tick past consequent encroachment here, and that's your rejection point there. So once again, these are super important, and generally, yes, each Nwog is valid for 5 weeks. Now, on the rare chance that it has not been touched at all in those 5 weeks, which is pretty much almost impossible, but there is still a chance of it happening, you'll keep it on for longer. And now you can kind of just see, and they become really strong and powerful magnets when they're inside each other. So if you have an Ndog and an Nwog inside each other, that's a really powerful magnet for price to gravitate towards. If you have 2 Nwogs in one, that's a really good really good idea to do the same. So the Ndogs are valid for 5 days. You'll have 4 Ndogs per week: Tuesday, Wednesday, Thursday. Sorry, you have 3 per week. No, you have 4, sorry. Tuesday, Wednesday, Thursday, Friday, right? And then you're from Friday to Sunday, which is technically Monday. Sunday/Monday will be your Nwog. So you'll have 4 Ndogs a week and 1 Nwog a week, and you'll keep 5 of them on the chart. So they're valid for pretty much 5 trading days. And you can see just how much price gravitates towards them. If you guys want this indicator right here, you can just search up really any Nwog Ndog indicator here, slap that on, and you can just see the way price gravitates towards it, and you can just see the levels and how price reacts to it and everything like that. You can see even as we go back further here, you can see price comes up to this Nwog right there up to the high, falls down. And you can see how we're in between 2 Nwogs and how we're just consolidating in between these 2 here. And then once we finally start breaking, we just break. and we break. And then we come back up, right? Once again, when you're around these levels, you're going to consolidate, right? You're going to consolidate, you're going to consolidate, you're going to consolidate. And that's basically what happens. So once again, as a quick recap, they're really good for draws and liquidity. They're really good to understand where price is going. If you see a lot of them down, chances are we're going to gravitate downwards unless there's a higher time frame draw on liquidity, like a daily liquidity we're really trying to get to. Generally, intraday, if you're looking for something and you see something like this here, right? You see your open here at 9:30. Let me show you this real quick. We'll go to our, we'll also put in our regular trading hours gap here. I don't know if it'll show, but okay, maybe it doesn't show, but we'll go to your regular trading hours real quick. Let me see if there was one. Okay, I don't even know what the fuck happened. Anyways, there'll probably be another regular trading hours gap somewhere here, and you can see probably price will come down here. Oh, yeah, I guess we started up here. Okay, here it is. So you can see we had our start of our first type of Ndog here. You can see us trade down to it, filling it, and we're continuing to come and take out all of these Ndogs, and you can see this is what we're using as our drawn liquidity there, just like that. All right, here we go. This is what I meant to do. Go into replay mode here. Yep, so this is what I meant here. So off market open, we can see we opened up here. You can see our new week opening gap has gapped us up higher. So we want to come down to at least a consequent encroachment level and further. And we can see that we have two new day opening gaps together right here. Very easy to gravitate to. We have two new week opening gaps here, right? And we can see just how easily we gravitated towards that just really quickly, right? And then we return back up into these here, and you can just tell how good this works. Look at the bodies here. Boom. Yeah, for sure. These are really, really important to have on your charts. Um, One of the most important things to have on your chart, honestly, and they're going to be really, really big magnets for price to go in that direction. And if you're thinking about taking a trade and you see that we're kind of consolidating at this new day opening gap, new week opening gap level, um, just have that in the back of your mind. A lot of times it shows it edging it. Would you recommend aiming standard deviations when targeting $8 as well? Just have a better target just in case I'm an edge. So what I would say in terms of trading your Ndogs and Nwogs is I actually did take a trade here, using it just the other day. I forgot where it was, but let me just hide the gap. Let me see where it was. It was a really nice expansion day. I don't think it was Friday, but it was not Thursday. But yeah, it was this day here. Now, when it comes to targeting them, was it this day? Shit, it might have not been this day. Hold on. Anyways, when it comes to targeting them, honestly, I would pretty much do it if it's like, how would I explain it? If it's near a drawn liquidity that you're going to take, like if it's internal to a range here, like if you're, let's say, targeting this high right here, for example, right? This would be a good idea if you're long somewhere here, right? Let me take a partial here just in case, right? And then let me take my final take profit here. Or you can fully target this right here if you wanted to, right? You can target, let's say down here, right? Let's say you wanted to take a short down here off this fair value gap, but you had no real liquidity to take to find a drawn liquidity on here, right? Let's say you entered on short right here, and you had, and your nearest liquidity was all the way down here, right? You can use this as a take profit, right? You have this as take profit one, and then you can have this as a take profit two, which doesn't get hit, but that's just some of the ways you can use it. Does that make sense? Oh, it was Tuesday. That's the day I took it. Actually, here. So what I actually used here was I actually went long right here. You guys can check the profit channels here, but I went long right here, right? First target was here, right? You noticed, and since here, we didn't have any liquidity to target except for really these relative equal highs all the way up here, and finally this high right here. right? So what are we doing if we're not confident, 100% confident in price coming up to here? Once again, you can use your new day opening gap right here. This could be another partial, and this could be another partial right here. Does that make sense? Yep, awesome. So, also one more thing, if you guys are looking to get into a trade and you believe the drawn liquidity is higher, having a new day opening gap or new week opening gap kind of intertwined with your entry here is another really good confluence to help put you guys higher. Is basically like having another fair value gap in there. So, do we have any more questions about how these work? Any more questions about how to target them or anything at all? I hope that answered your question, Dom, too, about the targeting. A lot of times, um, yeah, a lot of times it can get edged, but from what I've seen, it's usually best if you're targeting it in a place internal where it's kind of like your next liquidity is here, right? You want a little bit more here. You don't have 100% confidence, but it's going to come up here. Take it at these two levels here. And you can see how much we slowed down once we came up into these levels here. Really slowed down the speed coming up into through there. And right, the second we broke out of it, you can see the speed that we had up there. Yeah, so right now I'm using, I can show you guys. So these are the two that I use here. I use this one because it just looks a little bit nicer on my main one. Usually I don't, they did a whole bunch of updates to it, but usually I just have these two here. The Ndogs and Nwogs. I have five of them on here. So this is the ICT Nwog Ndog by Fady, whatever you want to say his name as. This is what I use for my Ndogs just because they look super clean. You can mess around with them. They say Nwog High, they say the correct date. And so I think this one is super good. And then this one I use specifically just for my opening range gap or that time between 9:30 and 10:30. Oh, sorry, the time between, yes, 4:15 and 9:30. My fault. I don't know. Yeah, 4:15 and 9:30, and that's what I use here. And then what you'll do is you'll just, if you don't want to use the indicator and you want to do it all manually, you just draw it out like, I was in replay mode. Fuck. But you'll just draw it out manually, basically, and then come back up into your electronic trading hours, and it'll be right there. And if you want to just draw it out by hand, you could do that as well. And you can use your consequent your fib levels if you wanted to as well. Okay. Any more questions we have here? If not, then we'll wrap this up. Okay, awesome. And one more closing note here. Um, if you want to look for shorts, ideally look for it above consequent encroachment of your new day opening gap. And if you want to look for longs, look for it below. Now, this doesn't necessarily have to be true, but that's just another way of looking for your best entries. It's just like your midnight open, 9:30 open, or your candle or your hourly open or whatever open you guys like to use. You guys can use it as a way to see if you're in a premium or a discount and to find kind of your best entries. Once again, like if you're going to look short here, go down and look for shorts here, right? You want to see price come above that consequent encroachment level, which it does give you one more time right here in that first fair value gap that forms. And you can just dump that down, right? If you wanted to target this new day opening gap. You can target this new day opening gap here as well. All right. If there are no more questions, I'm gonna wrap things up here. For sure, for sure. And again, if you guys have any questions, just say it in the trading chat.